I want to start with a number that came out of Yale University back in January. Not a prediction from some guy on the internet. Not a doom and gloom blog post. A projection from the Yale Budget Lab, which is one of the most cited economic research institutions in the country. And what they calculated was this. Under the current tariff regime, payroll employment in the United States would be approximately 1.3 million positions lower by the end of 2026. 1.3 million jobs, not lost in a financial crisis, not wiped out by a recession, eliminated by trade policy, and that number was published in January of this year. We are now in April. And guys, the data that has come out since then is tracking almost exactly where Yale said it would go. And then on Friday morning, the government dropped the March jobs report. 178,000 jobs added, unemployment steady at 4.3%, labor market resilient. Every major financial network ran the same headline within 4 minutes of the 8:30 a.m. release. And the anchors put on their reassuring faces and told you things are basically fine. But buried in that exact same government document, in a section that never makes the broadcast, is a completely different set of numbers. The household survey, which calls actual American families and asks whether anyone in their home currently has a job, showed that 64,000 people lost their jobs in March, not gained, lost. While the headline was celebrating 178,000 new positions, the measurement that tracks real human beings was moving in the opposite direction. 178,000 up on one survey, 64,000 down on the other. Same month, same labor market, same country. Today we are going to read the one they buried. Every single month, the Bureau of Labor Statistics releases what they call the Employment Situation Report. And inside that one document, there are two completely separate ways of counting employment that can and do tell completely different stories. The first one is the Establishment Survey. That is the headline number, the 178,000. It works by calling businesses and government agencies and asking how many people are on their payroll. Big sample. Fast data moves markets. This is what runs on the ticker tape every first Friday of the month. The second one is the Household Survey. This one does not call businesses. It calls actual households, real families, and it asks them directly whether the people living there currently have jobs. It captures a broader picture because it includes self-employed workers, gig workers, agricultural workers, people who would never show up on a corporate payroll. And in March, it showed 64,000 fewer Americans were employed compared to February. Here is the thing, guys. These two surveys disagree by small amounts all the time. That is normal. What is not normal is the size and consistency of the gap we have seen for months now. In January, the headline showed 160,000 jobs gained. In February, the headline was first reported as minus 92,000 jobs, then revised down to minus 133,000 after the full data came in. Then March came in at positive 178,000 on the headline, while actual employed people fell by 64,000 on the household survey. And the revision pattern tells you something critical. Every single month in 2025 was revised downward from its initial report. Every one. Some months that were originally reported as positive actually flipped to negative once the final numbers arrived. The market moves on the first print. The correction lands quietly a month later when nobody is paying attention anymore. The Fed chair himself acknowledged recently that payroll employment growth has been overstated and that real data shows the U.S. has been losing jobs since April of last year. That statement barely made the news, but it should have led every broadcast. Now let me tell you what the actual layoff data shows for 2026, because this is where the Yale projection starts to look very real very fast. Challenger, Gray & Christmas, which is the firm that tracks job cut announcements from U.S. employers every single month, just released their Q1 2026 report. The number, 217,362 job cuts in the first 3 months of this year. January alone came in at 108,435, the highest January total since 2009. Guys, the comparison they are using is the Great Recession, not 2020, not the tariff scares from the first Trump term, the Great Recession of 2009. That is the bar January 2026 just cleared. February brought another 48,307 announced cuts. March added another 60,620. And in March, for the very first time ever, artificial intelligence was cited as the #1 reason for job cuts, specifically 15,341 positions in a single month attributed directly to AI. Not restructuring, not market conditions. AI. And if you look at just the 92 largest corporate layoff events tracked by Layoff Hedge, the Q1 total at those companies alone was 294,672 jobs, nearly 300,000 positions at major corporations, gone in 90 days. The sectors getting hit hardest: technology with 52,150 cuts in Q1, a 40% increase from the same period last year. Transportation with 31,702 cuts. Healthcare with 19,228, and healthcare was supposed to be the one sector that does not get touched. The sector breakdown is telling you that this is not a concentrated tech correction anymore. This is spreading. I was looking at the layoff tracker from Crunchbase earlier this week, and there was an entry that stopped me cold. Oracle, 30,000 workers, gone. The company cited investor pressure over AI spending costs and a drop in share price. One announcement: 30,000 families scrambling, and that number has not even landed in Q2 data yet. Amazon cut 16,000 people in January alone as it restructured management layers. Meta is back on the layoff tracker, cutting Reality Labs jobs, Dell, HP, Microsoft. The list from just the first week of April includes Oracle, Fujitsu cutting 10% of its UK workforce, and multiple smaller closures hitting hundreds of workers each. And guys, the reason companies are giving for these cuts has completely changed. They are not saying they are struggling financially. They are saying the opposite. They are saying AI is improving productivity, and therefore they need fewer humans. And the stock market is rewarding them for it. Share prices go up when layoffs are announced now. The incentive structure has completely flipped. Glassdoor's analysts have a name for what is happening. They call it the forever layoff era. Companies are no longer doing massive, once-a-decade restructurings. They are doing frequent, smaller, rolling cuts that are becoming the permanent operating mode of corporate America. RSM's chief economist calls the current dynamic low hire, more fire. Companies are not growing headcount. They are not backfilling vacancies. When they cut fast. 58% of U.S. companies in a recent survey said they plan to lay off more employees before the end of 2026. 37% said they expect to replace roles with AI specifically by the end of this year. Not someday, this year. And 22% said AI is already lowering their staffing needs right now. The math on where jobs are going in 2026 is not complicated. It is just uncomfortable. Since federal employment peaked in October 2024, the U.S. government has cut 355,000 workers, an 11.8% reduction in roughly 5 months. And in March alone, another 18,000 federal positions were eliminated. 355,000 people. And I want you to think about what that means in human terms. These are people who had stable jobs with benefits, pensions, and income they had built their financial lives around. Mortgages taken out on that assumption. Car payments, kids in school. That assumption is now gone for 355,000 families. But the part that almost nobody is covering is the downstream effect. One analysis found that an 18,000-person federal reduction in Virginia alone would eliminate nearly 40,000 total state jobs when you count the ripple into private sector contractors, local businesses, and service workers who depended on that spending. Scale that math to 355,000 federal cuts nationally, and the true job loss number from this single policy decision is dramatically larger than what the BLS federal employment line shows. These downstream losses do not appear as federal job cuts in the data. They scatter across the private sector in slow motion. Empty desks at government contractors in Maryland, slower traffic at restaurants near federal buildings in D.C., retail closures in Northern Virginia suburbs where the customer base just got 15% smaller overnight. By the time these losses surface in the official data, the original cause is yesterday's news and nobody connects the dots. And layoffs are not the only thing happening to workers who are still employed. The average workweek fell to 34.2 hours in March. Employers cut hours before they cut headcount. When the work week compresses across the entire private sector at once, it typically leads layoffs by 2 to 3 months. Watch that number in April. Let us talk about the people who are completely invisible in the 4.3% headline, because this is where the human reality of this jobs crisis becomes impossible to argue with. Discouraged workers, people who have stopped looking entirely because they believe no job exists for them, rose by 144,000 in March alone. Total discouraged workers are now at 510,000. More than 500,000 Americans have looked at this economy and concluded there is no place for them in it. They are not in the unemployment rate. They do not count as a problem in the press release. They are just gone. 1.9 million people are marginally attached to the labor force. They looked for work sometime in the past year but gave up in the last 4 weeks. That number jumped by 325,000 in a single month. 4.5 million Americans are working part-time because they cannot find full-time work or their employer cut their hours. These people are counted as employed in the headline. They are listed as a positive data point. But they are not earning full-time wages and most of them are not accessing benefits. They are one unexpected expense away from a financial crisis. And 6 million people are completely outside the labor force but say they still want a job. 6 million, not counted, not tracked in the main number. The real measure of labor underutilization, the U6, which includes all of these groups, came in at 8% in March, not 4.3, 8. And the labor force participation rate dropped to 61.9%, the lowest since November 2021, after 396,000 people exited the workforce in a single month. When that many people stop looking, the unemployment rate stays flat, not because things are improving, but because the discouraged are no longer counted. That is the system working exactly as designed. The Yale Budget Lab updated their tariff analysis on April 2nd of this week. The current average effective tariff rate stands at 11%, the highest since 1943, excluding last year. And according to their latest modeling, if the current Section 122 tariffs are extended beyond their 150-day scheduled expiration, the price impact on the average American household reaches $1,130–340 in annual purchasing power loss. Even under the more optimistic scenario, where those tariffs expire on schedule, the loss is $650 to $780 per household per year. That is not a theoretical number. That is money that comes out of your grocery budget, your gas tank, your utility bill. And here is how it connects directly to jobs. 65% of supply chain managers in a recent survey reported cost increases of at least 10 to 15% from tariffs alone. 34% reported increases above 15%. Companies absorbing those cost increases have two options: raise prices on consumers or cut payroll. Usually they do both. Every time a company decides not to backfill a vacant position because their margins are under pressure and revenue is uncertain, that is a job that disappears without ever making any layoff tracker or any BLS report. The tariff to job loss pipeline is not theoretical. Yale modeled it, Goldman Sachs modeled it, JP Morgan modeled it. They all point the same direction. The exact number varies by scenario. The direction does not. And wages at 3.5% year over year are not keeping pace with either inflation or the cost increases consumers are absorbing from tariffs. Real purchasing power is still going backward for the average American worker. More dollars on the paycheck, less of anything you can actually buy with them. Moody's AI-driven recession probability model is currently sitting at 49%. And when back-tested against 80 years of historical data, every single time that model crossed the 50% threshold, a recession followed within 1 year. We are at 49%. The S&P 500 is down roughly 7% year to date. The NASDAQ is down over 10%. The CAPE ratio for U.S. stocks is at 39.8, the second highest stock valuation in 150 years of market history. The dot-com peak was lower than this. And the average effective tariff rate is the highest since 1943. Oil prices spiked 66% in 10 days after the Strait of Hormuz situation, and every U.S. recession since World War II, except COVID, was preceded by a fuel price spike. Goldman Sachs puts recession odds at 25% and thinks the second half of the year could improve if tariff policy stabilizes. EY Parthenon just bumped its recession odds to 40% and said those could climb fast as each week passes. Oxford Economics says a global recession would require oil above $140 a barrel for 2 months. The range of professional opinion goes from cautious to alarmed. None of it says ignore what the data is showing. And here is the thing about recessions and jobs that people forget until it is too late. When a recession hits, the S&P 500 has declined between 20% and 55% every time since 1980. The jobs that disappear in a recession are not the same as the jobs that were already being cut. Recession job losses are sudden, widespread, and hit sectors that looked fine a quarter earlier. The people who avoid serious financial damage are never the ones who started preparing after the recession was officially declared. They are always the ones who saw the Moody's number at 49% and took it seriously. Here's the bottom line on everything we covered today. Yale Budget Lab projected 1.3 million payroll jobs gone by end of 2026. Challenger confirmed 270,362 job cuts in Q1 alone. 294,000 jobs disappeared at major corporations in 90 days. Oracle cut 30,000 this week. 355,000 federal workers gone since October. The labor force shrank 396,000 in March. 510,000 Americans are too discouraged to look for work. Long-term unemployment is up 322,000 from a year ago. Real wages are still negative in purchasing power terms, and Moody's recession model is at 49%. The headline said 178,000 jobs added. The household survey said 64,000 people lost jobs. The Fed chair said payroll growth has been overstated since April of last year. That is the full picture, not the one on the ticker tape Friday morning. So what do you do with it? Emergency fund first. 6 months minimum, 12 is better. In a market where the average job search is running 6 to 12 months for displaced workers, financial runway is not optional. It is the variable that determines whether a job loss is a rough transition or a financial catastrophe. If your income is concentrated in tech, logistics, healthcare administration, or government contracting, start building your backup now. Not panicking, building. A second skill, a freelance capability, something. Stay out of new debt. The people who come through the next 18 months without serious financial damage are running lean right now. Know your investment allocation. 49% recession probability against the second most expensive stock market in 150 years is not a time for complacency. We cover this every week because the number they lead with on Friday morning is almost never the number that matters. Subscribe to the channel. Tell us in the comments what the job market looks like where you are right now, and check out the next video on your screen. We will see you in the next one.